I've heard that you can pay off a property in your self-managed super fund in just 7 to 10 years. I mean, how can that be?
That is exactly right. And there's where it gets really interesting from a banking and tax point of view. Let's look at the money that goes into the super fund. There's your rent from the tenant, employer contributions, voluntary contributions, taxed at only 15%. Let's say the tenant's paying you $400 per week in rent. That is $20,800 per annum.
What about the super your employer would normally put into a retail or industry super fund for you? Can we put that towards paying off the property?
Absolutely. And let's say your employer and your spouse's employers both put in 9%, say $8,000 per person per year. That's 16 grand per year coming into your trust account. Let's say you and your spouse voluntarily put in $15,000 each in every year, and you only pay 15% tax on those contributions too, instead of your marginal tax rate. That's $30,000 into the fund. Some call it salary sacrifice, but you certainly are at liberty to do those things. Yes, you can.
Now that's a total of $66,800 in income. Now, of course, the fund has to pay for the interest and the expenses on the property too, doesn't it?
Absolutely, yes. It must be neutrally geared. In other words, it costs you nothing to own the investment house. It costs your fund nothing to own the investment house. So let's look at what the super fund has to pay out in each year. There's interest on the loan at about 7% these days. I can get the loans for my clients. On $250,000, that's about $17,500. Rates and other expenses, let's say, on average, they're about $5,000. That's just $22,500 per year to maintain the loan and the property.
Yeah, so in rough basic terms, that means you have an excess of $44,300 in the super fund each year.
If you use those excess funds to pay off your bank loan, you can see how easy it would be to wipe out that $250,000 loan within 10 years. This is a true offset line of credit. It's marvellous how they work, I promise you.
It's really impressive. I can see why financial planners would encourage their clients to go down this path.
Well, so they should. And what's more, it's quite flexible. If you can afford to pay more into your super, you can, or if you can't, you don't.
And that's not even taking into account the tax deductions you'll get from your property if you buy new or off the plan.
Exactly. All those deductions go into the fund to pay off the loan. When you buy a new property, like the ones we are offering, with amazing tax deductions and very little maintenance costs, the figures become even more extraordinary, I reassure you.
I can see why people are so excited about this new tax-saving structure. I mean, best of all, it would seem that the government are actually encouraging us to invest. So the likelihood of them changing their mind or applying that retrospective tax law later on is virtually nil.
It means you can go ahead and invest with great confidence, and that's what we need these days, confidence. Unlike some other tax schemes, like we've all heard of them, the emu farms or the timber plantations that have left people with massive, and I mean massive tax bills over 10 years. Some, in fact most, have even lost their capital completely, would you believe?